This week, Ben and I are talking about some private yield estimates along with some adjustments to farm income expectations. Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
I'm doing all right. How are you this morning, Will?
I'm appreciating now, I guess the Texas version of fall weather is finally kind of arriving. I got up this morning, it was like 55, 60 degrees. The morning before that was about 60, so I'm enjoying the mornings at least.
Sure. Yeah, we've had some beautiful weather here in central Missouri as well. We'll take it.
Yeah, yeah, and it always makes me really happy because it feels like football season. You know, the weather and the we were grilling last night, so it's very good. Some notable Midwest games happened, I guess, over the weekend. Iowa State over Iowa there in that battle, and then Illinois over KU. So always happy about that. But
Yeah, great football. We have some really marquee matchups now early in the season, so
mhm.
it's made for some exciting football.
Exactly. Well, talking about some excitement in football, there's a little bit of excitement in the markets, but it's mostly just minor changes. Giving a quick rundown on the adjustments here on the week. December 24 corn up 6 cents at 407. December 2025 corn up 7 cents at 445. November soybeans up 18 cents at 1018. November 25 soybeans also up 18 cents at 1063. Soybean oil on a cents per pound basis for December down 1.51 cents per pound at 40.48. Soybean meal on the short ton basis for December up $11.90. The 2024 wheat crop for December up 16 cents at 568. July 25 wheat up 13 cents at 604. October cotton down 1.61 cents at 67.54. And then that West Texas intermediate crude oil contract down $4.98 a barrel at 68.85. So Ben, a lot of light gains across a lot of commodities, and then some maybe drop of fuel input prices there. What is this week's picture really looking like?
Well, we've seen a little bit of a rally here in some of our grain and oilseed markets. I think part of this is due to we got to the first notice day at the end of August for the September contracts. We had a flood of grain into the market, so that has allowed kind of some of the old crop to get off our backs, off our shoulders here for a second. We really haven't seen the new crop really start to flood the market yet. Storage space is kind of still full. So, we've seen a little bit of fundamentals come back into the market. These lower prices have generated some international demand, and that's helped pull our prices up a little bit higher. I think in the near term, I do have a little bit of concern for some more downward pressure. We're down 12 cents today, this morning in the November soybean contract. So that wouldn't necessarily be representative in the
Of the
weekly
week to week spread.
changes you just read.
Yeah.
You take into account that 12 cents from overnight last night, and we're basically flat on the week. So I think in general, that's my anticipation is we're going to see rather flat prices to even slight deteriorations in the week ahead.
Well, and some of that, looking at a lot of the private estimates and adjustments that we saw last week coming into this week, it's largely in line with USDA, but really strong expectations and all really close to one another. Looking at a yield estimate of an average of about 182, 183 bushels for corn, and then around 53 for soybeans. So, Ben, you look at those strong production numbers, and it's kind of hard to see looking farther out too much support being sustainable within the market if those numbers come to fruition.
Yeah, I think what these private analysts and trade estimates are kind of teeing up here is we are looking at a record corn and soybean crop across the U.S. The debate is just how big of a record. So some of the public estimates that came out last week were anywhere between 182 and a half to 183. That was kind of the general census or consensus. That compares to USDA that's at 183.1, right? So, at the most bullish, it's just a half a bushel decline on that national average yield. Which, don't get me wrong, that's a half a bushel does amount to several million bushels here, or it does add up. But I think if I had to just summarize this, I would say that the private analysts and their companies, and then even what we're seeing in farmer surveys as crop progress continues now that combines are starting to roll. I think what we're seeing is that the corn crop is there. There's still some concern about this bean crop and getting pods filled through development with kind of some of the lack of moisture that we're seeing develop across the corn belt. But I think the corn crop is there. It's very large, and USDA will have an opportunity to update their estimates for September here on Thursday of this week. So I'm not expecting a whole lot of change on the yield front, really.
Well, and Ben, this kind of alludes to two different mindsets maybe when growers are looking at planning out the growing season, with discussions around input prices. You hear the two mindsets of, oh, input prices are really high, so I got to find ways to make cuts where I can, or the opposite view is inputs are really, really high. I better really focus on growing a bumper crop this year and go all in. And now we're seeing the situation with yield estimates so high, and that's impacting farm incomes as you see prices maybe pushed down, but also if you do get that bumper yield, maybe being somewhat supportive. But anyway, all that to say, USDA has updated September farm income expectations. Looking at that picture now, it's looking a little bit more favorable than it was for livestock producers. But really, I don't want to creep too much into the livestock side of things with our sister program there. But what's your takeaway looking at those September kind of numbers for expected farm incomes?
Well, not as dismal as what was initially expected or forecasted back in early spring. We did see U.S. net farm income decline year over year, even in this update from 2023 to 2024, but it didn't decline as much. And as you alluded to it, a good chunk of the reason it didn't decline as much in the forecast was because livestock and livestock product receipts were higher. We also see, some relief in the input cost market. That's mostly, again, driven by the livestock sector. Lower crop prices translate to lower feed cost for livestock producers. And so really a lot of that gain was on the livestock side. The crop side is still pretty dismal, pretty weak. And so still a year over year decline in net farm income. Some people will look at that number and say, well, there's no way that, this picture can be even this rosy given where input costs are relative to prices. Some states will have a bigger impact of this than others, right? So a more diverse state like Missouri, where we have quite a bit of cattle, third largest cattle producing state, a lot of cow-calf producers are seeing very strong profitability. We're going to fare this downturn a little bit better than states like our neighbors, Illinois and Iowa, just to name it two, just because they have such a high concentration and such a high volume of receipts that are tied to row crop production.
Well, and Ben, looking at those expected incomes, they are kind of, like you say, a little abysmal on the crop side of things. But there are, some silver linings on some supportive factors. We are seeing kind of the rundown, the closeout on ethanol for the summer driving season. So you're seeing some numbers drop there, but still above, year over year where they are comparatively in the week. And then along with the soybean crush numbers are still elevated, even though, we are seeing a little bit of a creep down in there. They're elevated above where they have been in previous years. So are these factors providing any type of support, any type of sustainable support, you think?
Well, so the domestic crush picture for both corn and soybeans has been the star, I guess is what I would say, the star all year round. If at least on the demand side, I think we could talk about how impressive our corn and soybean yields have been, given just challenges, right? Too wet early on, then dry here to finish. But on the demand side, the star has really been ethanol crush or corn crush for ethanol, and then soybeans crush for soybean meal and soybean oil. So that has helped. It certainly has helped. I think a lot of that has been baked in at this point. Just looking at kind of where we're finishing the year on the corn ethanol picture, this last week, we had 312 million gallons of ethanol produced here in the United States. 312. That compares to 298 million gallons last year and 285 million gallons, over the previous 3 years. So up anywhere, depending on how you look at that, up about 30 million, 25 to 30 million gallons of ethanol production this week compared to historical. When I look at corn used for ethanol through at least the marketing year that I have estimated, I have corn used for ethanol up 4.8% on the year. That's a little bit softer than where USDA is at the moment, but certainly I think we could hit it You know, there's always some error in terms of like the blending volumes and stuff, and so it'll take a couple of months to get that figured out. But I think we're going to be right in there, right, maybe 10 million bushels short of USDA's current target, but that's nothing to get worked up about, right? Like still very strong ethanol production for the year. Of course, on the soybean side, US or the National Oilseed Processors Association will update their crush numbers next Monday, so we'll get an idea of what that looked like for the month of August.
All right, Ben. Well, looking forward into the next week, what should farmers and ranchers really be paying attention to that could move the needle on the markets?
Yeah, so we got a couple of economic reports. This will probably be the last set of economic data that comes out before the Fed meets in a couple of weeks. The Federal Reserve Open Market Committee meets in a couple of weeks. So CPI comes out Wednesday, PPI index comes out on Thursday. The other big thing on Thursday, especially for grains and oilseeds, is USDA gets an opportunity to update their crop production and demand estimates in the WASDE report. As I mentioned at the onset, I'm not expecting a whole lot of changes in that yield. However, this is September is the first month where USDA incorporates field surveys, or they go out into the field and they actually look at plants and those objective field studies. So that'll be mixed with farmer surveys and satellite data to create an estimate. So we could be in for a surprise. Like, I'm not expecting one, but certainly it is on the table. And of course, then they'll get a chance to update those demand numbers as well. There's a couple of categories in the old crop and the new crop where I think we could see some changes, namely in new crop soybean exports, and then certainly on old crop corn exports as well. So I guess to finish that statement, higher old crop corn exports for 23-24, lower new crop soybean export estimates for 24-25. Outside of that, the other big thing, and I already teed this up a little bit earlier, is next Monday, September 16th, the National Oilseed Processors Association will release their August crush report.
So quite a lot to look at this upcoming week, and some things that could move the market, both the general economic market and on the ag side. Ben, thanks for your knowledge and information on the program. It's much appreciated. Viewers and listeners, if you'd like to learn more about us and what we do or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.